On December 10, 2025, something remarkable happened in precious metals markets. The Federal Reserve announced its third interest rate cut of the year, lowering the federal funds rate to a range of 3.5% to 3.75%. Within hours, gold surged past $4,250 per ounce, hovering near its all-time record. Silver spiked to a new all-time high above $61 per ounce. This wasn't just a typical Fed cuts rates, gold goes up reaction. This was confirmation of a fundamental shift in how global markets view gold and the US dollar. I've been tracking gold markets for years, and what I'm seeing now is different from every previous cycle. This isn't about inflation hedging. This isn't about recession fears. This is about a structural breakdown in confidence in the Western monetary system, and gold is the beneficiary. Let me walk you through what just happened, why it matters, and why major banks like Goldman Sachs are now forecasting gold at $5,000 by late 2026. First, let's understand what the Fed did on December 10th. They cut the benchmark interest rate by 25 basis points. This brings rates down from where they peaked at 5.25%, 5.50% earlier in the cycle. The Fed has now cut 3 times in 2025, each time by 25 basis points. Fed Chairman Jerome Powell explained the decision by pointing to a softening labor market and progress on inflation. The unemployment rate has been creeping higher, recently hitting a 4-year high. Inflation, measured by PCE, came in at 2.1% overall and 2.5% for core inflation, still above the Fed's 2% target but getting closer. Powell's reasoning was straightforward. Cut rates to support the labor market while inflation trends toward target, standard central bank logic. But markets heard something else. They heard that the Fed is willing to ease policy even with inflation still elevated, even with massive government deficits, and even as other central banks hesitate to cut. Gold traders saw confirmation that real interest rates, nominal rates minus inflation, will stay low or negative. And when real rates are low, gold becomes more attractive because the opportunity cost of holding it disappears. But here's what makes this different from past cycles. Traditionally, gold rallies when rates fall because lower rates weaken the dollar. A weaker dollar makes gold cheaper for foreign buyers, boosting demand. That relationship held for decades. But in 2025, it's breaking down. Gold rallied alongside a relatively strong dollar for much of the year. The traditional inverse correlation stopped working. Why? Because the dominant force in gold markets is no longer short-term interest rate speculation, it's central bank buying and sovereign diversification away from dollar assets. Let me give you the numbers. In 2024, central banks purchased over 1,000 metric tons of gold. That's the third consecutive year of purchases exceeding 1,000 tons. For context, annual global gold mine production is around 3,000 to 3,500 tons. Central banks are absorbing nearly 1/3 of new supply. Who's buying? China is the biggest buyer. Official data shows the People's Bank of China added gold reserves for 13 consecutive months through late 2024 and continued buying into 2025. But analysts believe the real numbers are much higher than officially reported. Goldman Sachs estimates China's actual purchases could be 10 times higher than what's publicly disclosed. Russia holds approximately $310 billion in physical gold bullion. They've been steadily accumulating since sanctions froze their dollar and euro reserves after the Ukraine conflict began. Gold can't be frozen by Western governments. It's physical, portable, and universally accepted. India's central bank has been quietly building reserves. Turkey, Poland, Singapore, and dozens of other countries are doing the same. This isn't diversification anymore. This is de-dollarization. It's a slow-motion exit from dollar dependence, and gold is the primary alternative. Now let's talk about Goldman Sachs because their forecast is getting a lot of attention. In their latest commodity outlook, Goldman raised their end of 2026 gold price target to $4,900 per ounce. That's up from previous estimates. Their analysts cite structurally high central bank demand as the foundation of their bullish view. Goldman's model suggests that even if private investors don't significantly increase gold allocations, central bank buying alone will drive prices higher. They calculate that every 100 tons of central bank demand lifts gold prices by at least 2.4%. With 1,000 plus tons being purchased annually, that's 24% structural support. But Goldman also sees cyclical tailwinds. They expect the Fed to cut rates further in 2026. Lower rates compress real yields, making gold more attractive relative to bonds. They also expect the dollar to weaken as rate differentials narrow between the US and other countries. Morgan Stanley published similar views. They forecast $4,800 per ounce by Q4 2026, driven by anticipated Fed rate cuts, a weaker dollar, and continued central bank demand, particularly from China. Some analysts are even more bullish. There's talk of $5,000 or higher if private investor allocations increase. Goldman noted that gold ETFs currently represent only about 0.17% of private US financial portfolios. Even small increases in allocation could have outsized price effects in a relatively small market. Let me explain why the Fed's policy matters so much for gold right now. On December 10th, the Fed didn't just cut rates, they also announced they would restart Treasury purchases, $40 billion starting December 12th. They're calling it maintaining ample reserves, but functionally, it's quantitative easing. The Fed spent 3 years shrinking its balance sheet from $9 trillion in 2022 to $6.6 trillion today. Now they're expanding again. When the Fed buys treasuries, it creates new money. That new money enters the financial system, and some of it flows into hard assets like gold. This is currency debasement. The Fed is creating dollars to finance government deficits. Gold, which can't be printed, becomes more valuable relative to dollars that can be. Now, the Fed would argue they're just managing bank reserves, not financing deficits, but the effect is the same. More dollars, same amount of gold. Gold's relative value rises. Let's talk about what's happening with silver because it's equally dramatic. Silver hit an all-time high above $61 per ounce on December 10th. That breaks the previous record from the 1980s when the Hunt brothers tried to corner the market. Why is silver surging? 2 reasons. First, it follows gold. Silver is often called gold's little brother. When gold rallies, silver usually rallies harder due to lower market liquidity. Second, industrial demand is exploding. Solar panel production consumes massive amounts of silver. Each panel requires silver for conductive pathways. As solar installation accelerates globally, silver demand keeps rising. The Silver Institute projects industrial demand will hit 700 million ounces in 2025, the highest ever. Meanwhile, mine production is barely growing and above-ground inventories are depleting. Supply deficits are projected for the 5th consecutive year. COMEX registered silver, the metal actually available for delivery, has fallen to just 47 million ounces. That's nothing in a market where annual demand exceeds 1 billion ounces. When deliveries are requested, prices can spike violently. Now let me address the elephant in the room. Is this a bubble? Are gold and silver overvalued at current levels? There are arguments on both sides. On the bubble side, you could point to rapid price appreciation. Gold has nearly doubled in 2 years. Silver's gain is even more dramatic. Historically, such moves often precede corrections. You could also argue that with real yields still positive in some maturities, gold should face headwinds. If you can earn 2 to 3% real return in Treasury inflation-protected securities, why hold zero-yielding gold? But the counter-arguments are compelling. First, real yields are being suppressed by Fed policy. The Fed is cutting rates and buying bonds simultaneously. This keeps yields artificially low. In a truly free market, rates would be higher given current deficits and inflation. Second, the structural bid from central banks is unprecedented. Never before have so many sovereign nations simultaneously accumulated gold at this pace. This buying is sticky. It doesn't reverse quickly. Third, geopolitical risk is elevated. Wars in Ukraine and the Middle East continue. US-China tensions remain high. When geopolitical risk rises, gold benefits as a safe haven. Fourth, fiscal sustainability concerns are growing. The U.S. government ran a $1.8 trillion deficit in fiscal 2025. Interest payments on the national debt exceeded $1 trillion. That's unsustainable. At some point, either spending gets cut dramatically, taxes rise massively, or the Fed prints money to finance deficits. All 3 scenarios support higher gold prices. Let me talk about what this means for the dollar, because that's the real story here. The dollar's role as the world's reserve currency depends on trust. Countries hold dollars because they believe dollars will retain value and remain liquid. But when the Fed cuts rates while deficits explode, when dollar reserves get frozen for political reasons, as happened to Russia, when inflation erodes purchasing power, that trust erodes. Gold is the alternative. It's no one's liability. It can't be printed. It can't be frozen or sanctioned. It's been money for 5,000 years. Central banks are voting with their wallets. They're reducing dollar exposure and increasing gold holdings. This isn't a prediction. It's already happening. The data is clear. What does this mean for investors? I can't give investment advice, but I can share observations. If you believe the Fed will continue cutting rates, if you believe central banks will keep buying gold, if you believe dollar dominance is eroding, then gold makes sense as portfolio allocation. Goldman Sachs research suggests gold allocations of 5–10% in balanced portfolios. Some wealth advisors recommend even higher percentages depending on risk tolerance and outlook. Physical gold, bars and coins offers direct exposure without counterparty risk. Gold ETFs like GLD provide liquidity and convenience but introduce institutional risk. Gold mining stocks offer leverage to gold prices but come with operational and political risks. Silver is more volatile than gold but offers higher potential returns if the industrial demand story plays out. Silver to gold ratio historically averages around 15.1. Currently, it's above 70.1, suggesting silver is undervalued relative to gold. What am I watching to track this trend? Several indicators matter. First, Fed policy trajectory. If the Fed pauses rate cuts or signals tightening, gold could pull back temporarily. But given labor market weakness, further cuts seem more likely than hikes. Second, central bank buying data. The World Gold Council publishes monthly updates. If buying slows significantly, that would change the structural support picture. Third, real yields. The 10-year TIPS yield is a key metric. When it falls, gold typically benefits. When it rises, gold faces headwinds. Fourth, dollar strength. The US dollar index, DXY, measures the dollar against major currencies. A declining DXY supports higher gold prices. Fifth, geopolitical events. Escalations in conflicts tend to drive safe haven flows into gold. Let me be clear about risks, because gold isn't a one-way trade. If inflation surges unexpectedly, the Fed might be forced to raise rates aggressively. That would strengthen the dollar and pressure gold. If central banks suddenly stop buying, perhaps due to fiscal constraints or domestic economic crises, that removes a major pillar of support. If economic growth accelerates dramatically, investors might rotate out of safe havens like gold into riskier assets like stocks. These risks are real, but based on current trajectories, they seem less likely than continued gold strength. My personal view is that we're in the early stages of a major monetary transition. The dollar-centric system that emerged after World War II is breaking down. Not collapsing overnight, but eroding gradually. Gold is reasserting its historical role as the ultimate money, not because governments decree it, but because markets are choosing it. The $4,350 price we're seeing now isn't the top. If Goldman and Morgan Stanley are right, we're heading toward $4,800 to $5,000 in 2026. Some even project higher if private investment demand increases. I've personally increased my allocation to physical gold and silver over the past year. I view it as insurance against monetary instability rather than speculation. But again, I'm not a financial advisor. This is not investment advice. Everyone's situation is different. You should do your own research and consult with licensed professionals before making any financial decisions. What I am saying is this: pay attention to what central banks are doing, not what they're saying. They're buying gold at record pace. That tells you everything you need to know about their confidence in the current monetary system. The Fed's December rate cut was just another step in a long process of currency debasement. Gold surge to $4,350 is the market's response. And if history's any guide, this is just the beginning. Stay informed, watch the data, and understand that we're living through a historic shift in the global monetary order.